Welcome to today's SilverOak quarterly webinar. My name is Shannon King, and I am partner and president of SilverOak, as well as the Chief Compliance Officer. And with me today, as usual, is Jonathan Charlo, also a partner of SilverOak, as well as our lead analyst. So thanks for joining us, Jonathan.
Yeah, thank you, Shannon.
As usual, today's webinar will be approximately 45 to 60 minutes in length. I frankly suspect it will go the 60 minutes today. I don't have any expectation that it's going to be shorter than that. If you have questions throughout today's webinar, please feel free to contact your SilverOak advisor after the session ends. If you're not currently working with a SilverOak advisor, feel free to contact me directly at 952-896-5701. And I want to thank Jonathan, as well as John and the rest of the SilverOak team for making this webinar possible. Honestly, it was maybe a tough webinar to compile because we typically would go over quarter 3 data, both economic and market data. And many times at this point, not a lot probably has changed since that quarter end, but that's definitely not the case this go around. So we spent the last few days adding some materials and gathering some additional data to hopefully discuss relative to the recent market activity that's been occurring. For compliance purposes, I do need to note that we will be discussing the overall markets and economy during this webinar. In doing so, we'll be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we will not be discussing specific SilverOak portfolio performance, as each of our client portfolios are customized. Nonetheless, I believe, Jonathan, we've had a chance to talk to many of our clients since the quarter end. Quarterly performance reports did go out probably 2 weeks ago, and hopefully everybody's had a chance to review those. If we haven't spoken with you, and if you do have questions regarding those reports, please feel free to contact your SilverOak advisor. We're happy to discuss any questions you might have. And lastly, I wouldn't be a good Chief Compliance Officer if I didn't add that past performance is no guarantee of future success. So let's look at the agenda. So Jonathan, today we're going to talk about economic data first, going through again Q3, as well as some data I think that was just released this morning.
Correct.
We'll go then into our market discussion. We'll give you some insight into our outlook going forward. And our special topic today is gift planning. So for all of those interested in giving either to charity or to individuals, i.e. Kids, we'll talk about different strategies in doing so. We'll end with SilverOak updates, some year-end reminders, and other noteworthy updates. And of course, as I mentioned, if you have any questions after the webinar, feel free to contact your SilverOak advisor. So let's start off the discussion on the economy.
The economy is very healthy, and all the data points we've seen in the third quarter, including what was released today, has been very good. So we'll start with the leading indicators. They were up again in September by 0.5%, up to 111.8. 8 of the 10 indicators were increasing. The only thing I would say, though, is the last 6-month moving average is starting to moderate a little bit. And there were a couple negatives, obviously, in there. And we'll talk about that when we go through our economic indicators. Manufacturing activity remains strong. The Purchasing Managers Index for September came in at 59.8. That was a 1.5% decrease from August. but 15 of the manufacturing industries of 18 did show growth in September. New orders were actually fairly strong, so kind of under the number, things still look very healthy. Consumer confidence was actually a number that came out today. The Michigan Consumer Sentiment Index came in at 98.6 versus last month's 100.1. But the moving average for the index this year has been 98.5. And so this just came in a little bit above. But what I will point out is that average is the highest annual average since the year 2000. So despite everything that's going on, it still remains strong. Now, I would suspect that with recent activity, next month's would likely go down from here. Small businesses, they remain confident. That index number did decline a little bit in September, but still it was at its third highest reading in the survey's 45-year history. So labor markets remain tight, and that remains the #1 concern of small business owners. Earnings have been strong. We're going to kind of go into that because certain earnings reports in the last few days have been a little bit lower. But Q2 numbers were very strong. So far this quarter, they are strong, but again, maybe not as strong as people were hoping. But the next 4 quarters do project growth, and the expectations are for further earnings growth. This was probably the biggest number that came out today. Third quarter GDP, the first preliminary estimate came in. It was up 3.5%. That was slightly above the 3.3% expectations. Most notable in there was personal consumption grew at a 4% rate. That was higher than the 3% expected. But there were some detractors to that, obviously. Exports were down. Now, the dollar's been strong, so that probably is not a big surprise. And residential fixed investment was weak, and we're going to talk about kind of what's going on in the housing market. But that's obviously cooled with high interest rates, or higher and increasing interest rates.
Sure. And you did mention just a minute ago about the dollar.
Yeah, so we did see the dollar strengthen since May. Now, last year, it was kind of in a downtrend and was at the lower end of kind of the new average. But it did tick up through May. And I think that has had an impact, obviously, on housing, exports, international performance, things like that.
Well, and we'll get to that. International obviously has struggled this year as far as international equities go. But if we think back to 2017, they did really well. And of course, that was in an environment when the dollar was generally declining, whereas this year it's generally been on the incline.
Correct, yeah.
So let's look at the current economic factors and the scorecard that we put together pretty much every quarter. What here has changed from prior quarters?
Really, not a lot has moved between the different categories. Now, certainly we did move geopolitics from neutral to negative. But within the different categories, we've seen some changes. So within positive, again, as I kind of hinted, housing has been a bit weaker. Again,
so it's trending down a little bit.
Trending down a little bit.
Not enough to go to neutral, but it's on its way if the current trend continues.
Correct, correct. Within the neutral category, we have a downward arrow for interest rates. Interest rates have been trending up. We've seen that especially in the last month or so. We've mentioned the dollar. The dollar strength has added to weakness in exports. Global growth, that's trended down a little bit more recently, as well as the Eurozone. And then China So these are neutral, but compared to where we were last quarter, some of these numbers have trended a bit lower.
So before we get into the market dashboard, overall, based on the data that you've discussed so far and what we're seeing under this scorecard here, things are still positive from an economic perspective, but we are starting to see some trends downward. Is that?
I think that's that's
summary.
Fair. That's fair. Even consumer sentiment, which remains at a high level, has come down and could come down a little bit. So that seems to be the trend we're seeing in the numbers.
Okay. So that brings us to then the market dashboard, which again we look at each quarter. If you look to the far right, you'll see our projected fourth quarter. Of course, we just ended out the third quarter. And the key here as we look down into the third quarter is the change that occurred in market sentiment. Can you explain that?
There are a lot of different sub-indicators within market sentiment, but one of those is volatility. And last quarter, it did come down because we did see a pickup in volatility in the first quarter.
So the volatility came down last quarter, which pushed the market sentiment up. Okay.
Right. And this is going to be one of those where the data through 9/30, so for the third quarter, looks a bit different than maybe it kind of actually looks today. And that's really where we now kind of look at that fourth quarter projected. And so when we look at that, for example, and again, these are forecasts, valuation, that actually goes to a neutral, but that's reflecting the market decline we've seen in October. But more importantly, as I mentioned, while volatility had decreased, we obviously know what's happened in October during this month. Volatility has actually increased.
Mm-hmm.
And so if we do that forecast again on the market sentiment, we are forecasting that that will go back to a neutral.
Okay.
And so the interesting thing then is we have two neutrals forecasted, which will actually pull the composite down to a neutral.
Sure, sure. And I really jumped in this dashboard assuming everybody is familiar with how this works, but there's four components of the dashboard: the economy at the top going across for the various quarters, credit markets, valuations, and then market sentiment, which is what we were just referencing. And at the very bottom is the composite, taking those four categories and kind of looking at them in total. For each of those squares, green is positive. I don't know, grayish color?
Grayish color, yes.
Is neutral, and red is negative. So we can see here over the last several quarters, most everything was positive, with the exception of valuations, and those have been negative for a while, meaning that the stock market's probably overvalued. But even if you recall back to 2016, when valuations started to go negative because they were too high, even at that point, Jonathan, you mentioned that that doesn't necessarily mean the stock market's going to come down, because there's been a number of times in history where valuations remain high for a prolonged period of time, and we really needed another one of those components to go negative for us to get maybe a little bit more negative on the projections of the market going forward. Is that a fair assessment of what we discussed?
That's a fair assessment. And then, you know, looking at this projection about market sentiment is really just reflecting what's going on in the market right now.
Sure.
So obviously, if the market were to improve as we go into next quarter, it might not be a neutral issue. It might actually go positive.
Right. It might stay positive.
It might stay positive.
Yep. Okay.
Yep.
Okay. Well, and let's look at the market dashboard in terms of the composite number.
So currently, the composite is at 3.89, and that's really where that red circle is. And then again, we're the rest, looking at those lines coming down, that's the projection. And I want to note that based on the forecast that we just showed you on the prior page, We are forecasting that in January, the composite number will cross that 3.25 neutral line, and then later in March, April, the 6-month moving average will hit that level as well. And just so you know what that means, it means that the dashboard would say that returns and risk for stocks and bonds is neutral at that, meaning it doesn't, it favors equities typically, it's not favoring equities necessarily.
And once it drops below the 3.25, it's probably favoring bonds, especially if it stays in that area for a period of time below the dark neutral line.
Right, and the other side, I'd also then add to that, is we did see this happen back in second half of 2015 into 16. So that what's going on right now does not necessarily mean that it's the end of this economic cycle or this market cycle.
Sure, good point. So with that, let's talk about the markets. In the third quarter was somewhat split in performance between U.S. and international. Of course, as we've alluded to, a lot's changed just in the last few weeks since the third quarter. And we'll touch on what has changed, but as of the end of the quarter, obviously all of the U.S. markets represented here at the top half are positive. And if we look at the international markets represented mostly in the bottom half of this slide, we'll see a lot of negatives. And frankly, with the performance over the last couple of weeks, a lot of those U.S. numbers are now negative as well, and the international are just negative more. That's
a fair assessment.
Kind of where we are?
That's okay. Kind of where we're at.
Okay. And again, we'll touch on that in a little bit more detail here in a few minutes. For the quarter, though, bonds did a little bit better. U.S. bonds actually ended the quarter slightly positive. And I say a little bit better, that's a little bit better than international, because global fixed income was down for the quarter. Commodities were down. Long short actually was positive, and rates were just slightly positive. That's real estate investment trusts. Also for the quarter, we saw kind of a continued trend of growth stocks outperforming value stocks. And you can see that in the left box, where under the growth column, those numbers are all larger than under the value column. And we generally saw large cap or large companies outperforming small companies. And those trends are pretty much consistent as we look over into the year to date, with growth again outperforming. Now that's one area that we have seen a more significant change in the last couple of weeks. And we don't have it here on the slides, but this morning we did pull off the year-to-date and three-month numbers. And on a year-to-date basis, large cap growth is now down 11%.
Yeah, that data has really changed dramatically. Large cap value is also down, but again, the gap has narrowed significantly. And I think where we can see this 3-month number is that growth is down more. And certainly when we look at as of the quarter end, we definitely saw growth stocks doing better, and especially technology. What we have seen this month, and we're kind of reflected in the last 3 months now, is those stocks are down more than the value stocks.
So growth outperformed up until the end of the quarter, and now it's converting over to value. And a couple of those growth stocks that really have been hit, Amazon came out with not great numbers last night, at least not based on expectations. And it looks like its drawdown for the year from the high to the low, probably the low being this morning,
yes,
was down 20%. Google, kind of in the same boat, came out with earnings last night as well that I think mostly disappointed. It's down 17%. Facebook obviously had some other issues a little earlier in the year, but it's down 32%. Netflix is down 28% from its high. So these are all kind of the drawdown amounts from their highs, which are pretty significant amounts being drawn down.
Absolutely.
Across these high flyers that, just a year ago, people couldn't get out of their own way to buy into them.
Right. And we've talked about, we felt that those stocks were likely overvalued. Certainly the fundamentals were strong, but I think we're in a situation now where expectations became so high that these companies can't meet it.
Sure. We talked about the strong dollar already, and referenced the fact that it's hit international equities. The year-to-date numbers across the board here, we can see are down. A few glimmers of hope on the Q3 numbers, although that's changed in the last couple of weeks as well.
Right.
And bond performance, again, year-to-date, generally down because of the rising interest rate environment. And this is not a surprise. I think we were saying even at the beginning of the year that we would expect bond performance to probably be down 1 to 3% for the year because rates were expected to be increasing, and that typically is what happens in the beginning of kind of an interest rate hike cycle. And you'll see kind of the same type of Q3 data, although we're going to show here in just 1 second what bonds have done during this period of high stock volatility. And actually bonds are doing what they're supposed to do, and that is to provide more stability in the portfolio, particularly in times when stocks are maybe seeing more downside risk. So to that point, Jonathan, you put these numbers together. This is through October 24th.
And so even these numbers are a little bit stale with today's sell-off, because certainly that 12-month figure for U.S. large caps is now flattish to down a little bit. The Russell mid cap would be down, and small cap would be down more. But when we look at that month to date number, you're seeing large cap U.S., mid cap, the Russell all down. Again, international is down again, even though it had been lagging even as of the end of the third quarter. But we have another slide in a couple slides where we'll kind of go through how bonds have done specifically versus a couple of equity categories in this sell-off,
right?
Not just in the month,
right?
So,
and I guess before we transition out of this slide, the one thing I'd like to point out, and we don't have it in today's webinar, but I think we may have done it either last quarter or the quarter prior. So I encourage people to look back at these prior webinars that we post to our website, because these types of declines really aren't that unheard of. I mean, a 10% decline is a pretty typical decline on average every year. I mean, sometimes more often, maybe it's 2 times in some years, 3 times in others, but on average, once a year, we get a 10% or so decline in the market. So even though it seemed very dramatic, and I understand it has some people concerned, I don't think it's anything really out of the ordinary that we don't typically see. It always feels maybe more harsh, but 10% declines are typical.
absolutely. I think part of the issue is that we really went through much of 2016 and 17 with low volatility without these declines. That it's been a while since we've seen it. Now this year we had one in January, we're having one in October.
Sure. Well, and the other thing to point out is that volatility tends to bunch. So I had one of our folks go back 18 years and look at the daily movement of the Dow Jones Industrial for the past 18 years. And over that time frame, which is 4,527 trading days, I believe, over that time, there were 87 days in which the Dow Jones in a single day lost 2.5% or more. So I just wanted to know, when it lost 2.5% or more, how quickly did it then have a day where that single day it made 2.5% or more? And the median number of days that it took was 6. So after, again, being down 2.5% on any single day, on average, well, not on average, but the median number of days until it was up 2.5% for a single day was 6 days. So the volatility does tend to bunch. If you have a big down day, you do tend to have a big up day at some point there shortly after, and vice versa. And again, we're going to be dissecting these numbers even further and providing more information, more than likely in our next webinar. But the downside that we're seeing is not catastrophic. It's not all that unusual. And we do expect, when we have big downturns, that volatility picks up and you get big upturns and big downturns, and they do tend to bunch in relatively consolidated periods of time.
So one of the things that's occurred is certainly volatility has picked up this month. And we had mentioned with the dashboard that when volatility had picked up in the first quarter and then declined, we did kind of see a change in the market sentiment. So it did go up and then kind of came down, and then in the last 3 trading days, it's now back up again. So it's kind of, as of this morning, it's at 26. And so that's that spike that you're seeing on the far right.
So the explanation for October's decline so far, and to be honest, nobody knows for sure.
Exactly.
But it looks like it was probably sparked by some comments from the Federal Reserve that indicated they may be a little bit more hawkish than people expected, that they would raise rates maybe a little bit more aggressively, or that the neutral rate was a little higher than everybody anticipated. I think it was that very week that those comments were made, that we saw the first downturn maybe 2 or 3 weeks ago. So there's fear that, of course, economic strength would cause inflation, right, to move higher, and then the Fed's got to raise rates even more to keep up with the inflation issue.
Right, and I didn't put it on here, but the next step is then that fear is that they raise rates too much, and then that actually causes us to get pushed into a recession.
Good point. Yeah, very good point. The tariff issues and how it is going to impact global growth is certainly on investors' minds, and is probably a component of what's playing into the recent market activity. We still have the overlay of Brexit and what's happening in the Eurozone as an overlay. The end of the synchronized global growth. I remember last year, I don't know how many times, like, turn on CNBC or some other program, and everybody's talking about the synchronized global growth, which seems to be decoupling a little bit thus far. So that's got investors somewhat concerned. And then the last two,
we talked about the strong dollar. That certainly hurt international stocks. And then this is really one we just added in our thought process in the last couple of days, is that the earnings reports, while they're strong, they're not as strong as people expected. So you look at Amazon, it really wasn't a bad quarter, but expectations were so high because their growth numbers have been so good that numbers had been kind of raised, and now we're at a point where they're not able to beat it. Right?
And we're going to get the runoff of the tax impact
as we go into next year.
As we go into next year, the comps, year over year numbers are going to get a little bit more difficult. So they still may be good. I mean, we talked about the earnings expectations still being good, but there may be a trajectory where they're not as good.
Right, and so I had talked on that earnings page that, quite frankly, the expectation for third quarter earnings was that they would be up 20%. What we're seeing so far is that they're up 15%.
Mm-hmm.
Now, without that 20% expectation, 15% sounds good.
Right.
But with the high valuation, high expectations, that's clearly a disappointment.
So let's talk about how bonds have done during this decline. And we vaguely touched on it a few minutes ago. But as we look from October 8th through the 24th, and as we've kind of touched on already, all of the equity markets are in negative territory. This is kind of the period that we've been referencing, the volatile period where markets started turning. However, during this period where markets since really October 8th have been down, bonds have done what?
They're actually up slightly.
Yeah, we expected. They are.
In fact, they're up about 0.4%.
Yeah, and maybe if we looked actually today, probably up even more than that, because
Correct.
I saw the 10-year was down. The yield on the 10-year had come down. So of course, yield and price act inversely like a teeter-totter. When yields go down, prices go up, and vice versa. So generally this year, interest rates have gone up, so bond prices have gone down a little bit. But during times of stock market downside risk, bonds are actually doing exactly what we want them to do.
And we've always said that when bonds have a bad year, they might go down 1 to 3% in a diversified bond investment, while stocks can go down more.
Yeah.
And so that certainly is something that we've seen this year. And then on the other side of that is when you do see that stock volatility, usually there's a flight to safety and bonds can actually be up.
Sure. So our outlook, first as it comes to the economy, growth moderate in 2019. I think we touched on probably trending lower than it has been in the past, but still strong. With earnings probably moderate, but also still strong. The problem is expectations, right?
Correct.
We've already touched on that. International economy, kind of the same story, continued growth, but just slower than over the last couple of years. And we'll really have to see what happens with Brexit and with China and the tariffs and all of that. That, frankly, is either going to improve these numbers or it actually could pull down our expectations. Equities.
Well, we've kind of talked about this. Valuations are relatively high,
although not as high today as they were 3 weeks ago.
That's true. That's true. And of course we've seen the strong earnings growth, so that's also helped. And so this is now kind of what we've seen in October is more about an expectations issue. And again, as you also mentioned, this doesn't mean that this is the end of this cycle, but it just means that to a certain extent, people are repricing kind of risk assets. 10% pullbacks are not that uncommon. We've had 2 this year. We had a 2-year period where we really had none. And then the other thing too is ultimately markets do follow economic growth and earnings. At this point, we know we're late in a cycle. It's hard to predict when things end, but we're not necessarily seeing any of those signs at this point.
Right. And of course, having said that, because nobody can predict that, maintaining a diversified approach that's consistent with your risk profile is probably paramount, more so now than maybe ever. Not again that we're at the end of the cycle, but we're closer to the end than the beginning. I think most people would agree with that. And so having that risk profile consistent with your investment strategy is exceptionally important. Bonds, we already alluded to the fact that this year they'll probably still end up negative, even though they're up because of the recent volatility, but I think for the year we still think probably slightly negative, 1, 2, 3% down. But as we look into next year, we expect that to transition back into the positive. Is that?
Yeah, and essentially bond returns, we're not predicting that bond prices will necessarily go up, but we believe your return will equate with the underlying yield of the bond.
Right. Good. Well, I wish we had a lot more pleasant things to talk about. Maybe we did this webinar on October 1st instead of now, but it's good to keep everybody apprised on what's happening in the markets. And again, to just reassure investors and particularly our clients that what we're seeing now is not anything particularly out of the ordinary or causes us great concern as we look forward longer term. So with that, let's talk about gifting because the season is approaching where everybody thinks about their year-end gifting, which is why we've incorporated this discussion for today's webinar. And when I think about gifting, I always think about first, who is the recipient of the gift? Is it going to be a charity or is it individuals? And probably the number one individuals that receive gifts are kids, right? Us giving kids gifts. So let's break out the discussion between those two components, and we'll start with gifts to charities. And here you really have a choice of assets. You can choose cash, you can choose stock, or now, over the last several years, you've had the option of also choosing your IRA. We like stocks. Of course, if you're going to do stock, do low basis stock. That's the best. Never give stock that either has a loss or has a short-term gain. There's some negative tax consequences in those situations. But low basis stock is really the best type of stock. For a lot of clients, they might want to consider using their RMDs though, the required minimum distributions, which if you don't know what I'm talking about, you're probably not 70 and a half yet, because an RMD only applies to those individuals who have IRAs or 401ks for that matter that are at least 70 and a half. You can use your IRA to gift that required minimum distribution directly to the charity, so that you don't have to recognize that as income on your tax return that year. Now, you don't get the charitable deduction, but that's okay. You didn't recognize the income either. And what this does do is it lowers your overall income, so it may reduce the extra premiums you pay in Medicare, because those are income oriented. The more income you have, the higher premium you pay. So if you can reduce your income by using the IRA RMD as a charitable contribution, that might get you into a lower Medicare premium position. The key here, if you're thinking about using the IRA, is you can't gift that to a charitable gift fund / a donor advised fund. It has to go to an operating charity like, a United Way or the church or wherever, but it can't go into a donor advised fund. And the maximum annual exclusion is $100,000. So if your RMD is more than $100,000, you only get credit for the $100,000 exclusion. The other things on gifting to charities,
you have to complete your gift prior to year end. So if you're writing a check, it has to be postmarked by year end. And if you're writing checks from IRAs, and again, you might do that just because that's convenient to do that. Mm-hmm. They also have to be cashed by year end.
Yep. So the key there is cashed by year end, not postmarked.
Right.
So if you're using your IRA and you're writing a check out of that, don't do it on December 31st, because it's not going to count for that year. It's got to be cashed. And then, of course, it has to be a gift to a qualified charity, with the exception of QCDs. Qualified charities include donor advised funds, but we just talked about that doesn't apply to RMDs, the gifts that you're making directly from your IRAs. As we're talking, I know we got a lot of acronyms: IRAs, QCDs, RMDs. I hope everybody's following. If not, if you have any questions, just call your SilverOak advisor and we'd be happy to walk through your situation with you. The other thing on gifting to charity is make sure you've got proper documentation. This is a really confusing area. There's different thresholds based on how much you're giving. If it's less than 250, you need contemporaneous written acknowledgement from the organization with the various components that's listed there. If it's 250 up to 500, you still need that written acknowledgement. In addition, you need a receipt that includes specific language that says no goods or services were provided in exchange for the gift. That's an absolute requirement, and we really encourage our clients when they give us their tax information, including their charitable receipts, that they include that language. If you're giving non-cash of more than 500, less than 5,000, then all those other items are needed, plus you have to fill out Schedule or Section A of Form 8283. If it's a non-cash contribution of 5,000 up to 500, you don't fill out Section A of 8283, you fill out Section B, which requires a qualified appraisal. The only exception to that is appraisals are not needed for publicly traded securities. Okay, and I've got a number of situations where we're dealing with this particular type of a donation or gift, and there is a lot of requirements to be a qualified appraisal to meet that definition, and they're very detailed. The IRS looks at these very closely, so be careful in getting appraisals that are truly qualified. And then at the upper end, if you're gifting non-cash items of more than 500,000, you need all of those prior items, plus you have to attach the qualified appraisal to your tax return. And the other thing I'll just note is when you're thinking of these individual categories in the 250 or the 500 or the 5,000 limits, you have to combine all similar items donated. So you have to combine, like, let's say, all your household items or all your clothing items. It's not per donation per item. So you have to make sure that you're grouping those appropriately. There are special rules for certain types of properties, such as automobiles and boats, which, Jonathan, we see every year or so. So if you claim a value of more than 500, you can deduct the smaller of the gross proceeds from the sale of the vehicle by the organization or the vehicle's fair market value at date of contribution. Unless your basis is lower, then you can't do that. You have to deduct your basis. And here, the key is you also have to attach Form 1098-C to your return, which the charitable organization should be providing to you. Miscellaneous other items.
So the items must be in good condition. So I always kind of laugh when you hear about celebrities and what they give. And if you remember way back to the Clintons, they donated clothes, and you kind of heard about that. Well, they have to be in good condition.
Were they questionable clothes? Was that the?
Well, I wasn't going to say it, but it was underwear.
Oh,
Yeah.
Oh, jeez. Okay.
So I just thought that was kind of odd, but hopefully they were in good condition.
All right.
You must have receipts from the charitable organizations prior to filing your tax return. And then with the Tax Cuts and Job Act, repealed the ability to deduct up to 80% of donations required to purchase season tickets, the seat rights, so to speak.
Yeah, yeah. And that one has impacted several of our clients as well. So and one that's kind of been under the radar. I don't think that one got a lot of publicity, but something to keep in mind if you're getting these seat rights from your alma mater, that is no longer going to be deductible literally at all. It used to be up to 80%, but now not at all. So with gifting to charities, we've talked a lot about kind of the process, but what's the tax deduction limitations? Because you can't deduct everything that you gift with no limit. There are a couple of requirements. First, you have to itemize your deductions, which makes sense. Second, you have to know what type of charity you're contributing to. Are they a 60% limit of AGI charity, which applies to all public charities, private operating foundations, and certain private foundations? If they're one of those, they're a 60% limit of AGI. That's as much as you can deduct. Well, at the maximum. If they're a 30% charity, that applies to private foundations, fraternal societies, etc. And that also applies to capital gain property to 60% organizations. So the 30% limit of AGI applies to capital gain property that you're making to a 60% organization. Okay, make sure you understand that. So if you're gifting appreciated stock and you're gifting it to a public charity, the maximum you can deduct is 30% of your AGI, assuming that the contribution was at least that much. And then the last is the 20% limit of AGI. So this applies to capital gain property that you're giving to a 30% organization, or capital gain property for the use by or of the qualified organizations. Okay. So again, I know this can be confusing. If you have questions, reach out to your SilverOak advisor and we can walk through it. But I think the one that impacts a lot of people is either cash, which is the 60% limit of AGI, depending on the type of charity, assuming it's a public charity, which many are. Or the other property is usually capital gain property. And again, it's usually to a public charity, which would mean that has a 30% of AGI limit. Those are the two most popular that we see most often. Okay. Remember, under the Tax Cut and Jobs Act, you may want to consider bunching your charitable contributions. And we went through this in detail. Kathy Nelson, one of our tax advisors and partners with SilverOak, she talked in detail about the new Tax Cuts and Jobs Act and how bunching charitable contributions may be beneficial for many taxpayers. And if you do the bunching, you probably want to use a donor advised fund, which we're going to very briefly touch on. So a donor advised fund is basically a charitable vehicle.
It's like a separate account devoted that you set aside to give to charities. You can contribute cash and stock into that account, and then you do receive the tax deduction upon making that contribution. You retain the rights to make grants out of the fund or account at any time in the future. And again, if you're thinking of bunching for 5 years, then you really can do it the same, but you're just doing it out of the donor advised fund versus cutting a check each year.
So you get the benefit of the upfront deduction, but the ultimate charity, the church or the synagogue or United Way, they kind of see the cash flow the same. They don't know the difference.
Right, and then it can be invested, that account. So it could grow over time.
And of course, there are some costs associated with donor advised funds. They're relatively low, but there are some costs. And we talked about why would you utilize a donor advised fund? Obviously, to bunch your charitable contributions, but there's other reasons like setting up a legacy fund, almost like a foundation, that you want to be part of the family legacy, to diversify concentrated holdings with very low basis stock. And the last one we see a lot is just simplify the administration, because you get the upfront deduction. That's all you have to track. You don't have to track all those miscellaneous contributions that you're then making to the various organizations. And I know that can be a kind of a headache for some people at the end of the year. So that was gifting to charities. Now let's talk about gifting to individuals, i.e. kids. And everybody can gift up to $15,000 per year. Per year per recipient is this year's limit. That includes to kids, by the way. If they exceed that amount, then there may be a gift tax return required. Now, there are exclusions for education and healthcare if you're paying it directly to the institution. And there's, of course, the lifetime gift exemption. Here you have a different choice of assets, or at least a more limited choice. Instead of cash, stock, and IRA, really we're just looking at cash and stock. And whether you want to gift low basis or high basis, that's really dependent upon the circumstances and your objectives. Okay? The key is you pretty much never want to gift stock that has a loss. Otherwise, you could just sell it, take the loss yourself, and get the tax benefit. Also, remember when you're gifting that
you carry over your basis and the acquisition date.
Yep, okay. And the kiddie tax. So a lot of people think, oh, I'll gift to my kids and let them sell a stock because they're at a lower tax rate. But we have to be careful of the kiddie tax. And I'm going to go through this relatively quickly. But just be aware, if you're gifting particularly low basis stock to your kids in anticipation that they're going to be in a lower tax rate, that may not necessarily be the case because of the kiddie tax, which applies to dependent children who must file a separate tax return. Who are dependent children? Well, I've listed out the definition of dependent children here. Under age of 18 at the end of the year, 18 at the end of the year, did not have earned income equal to more than half their support, so they didn't basically support themselves for 50% or more, or age 19 to 23 at the end of the year, didn't have earned income equal to that 50%, and they were full-time students. Okay, so that's a dependent child. Do they need to file a separate return? Well, I've laid out the requirements here. And I should note, these numbers actually may change a little bit. The final numbers for 2018 haven't been released. The standard deduction has, but these other numbers have not been released. So these are, at this point, what we think they're going to be, but that could fluctuate a little bit between now and the end of the year. So if they're a dependent and they need to file a separate tax return, then they're subject to the kiddie tax, and that means that on their unearned income, they're going to be taxed according to this schedule. If it's interest and short-term capital gains, it's at these various rates. If it's long-term capital gains and qualified dividends, it's at these various rates. So to get to my earlier comment, if you're thinking of gifting low basis stock to a child so that they can sell it and be taxed at a lower rate, well, if their capital gains combined is over $12,700, they're going to be at the highest capital gain rate, 20%, which for many of our clients, that's the rate they're at. So there's no tax benefit under that particular scenario. The other thing to consider is that if you forgive a loan, that's a gift. So if you've loaned, let's say your kid some money, and you think, oh, I'll just forgive it, that is considered a gift for that year, and it's combined with all the other gifts that you've made. Okay.
So other things to consider, you have to document the loan with a promissory note. You're going to have to charge a minimum interest rate. It's called the AFR. We talked about acronyms, applicable federal rate. There are 3 different rates, the short term, midterm, and long term. These you can get online. And if it's a loan for a home, you're going to need to record it properly, as well as have that promissory note so that the deduction can apply.
Sure, sure. Yeah, and that I think a lot of people miss. So that's a key one. Make sure you record it with the county and the home's the collateral, or that child's not going to be able to take that interest as a deduction on their tax return, which would be a real shame. Gifting to grandchildren creates some additional opportunities. And frankly, this could be to kids as well, but usually we see it to grandchildren, where you might want to consider using 529 plans. There's some pros and cons to doing this that we can talk through, but prior to distributions occurring from the 529, you may want to convert the owner of the 529 from the grandparent to the parent. And this is kind of getting into the weeds, but just know if you're wanting to gift to grandchildren, 529 plans may be a good option. But there may be some planning extra that needs to be done before the child goes off to college. You can use irrevocable trust, and then there's a whole number of other trusts, both for charitable and non-charitable purposes, which frankly, getting into that conversation could take an entire 2 or 3 hour session. So if you have any questions, reach out to your SilverOak advisor to talk about those. On to our last section for the day, and we'll wrap things up right on time. Our SilverOak updates, year-end reminders, and other noteworthy items, which there are a couple that I encourage you to stay tuned to the end of our discussion that I think are going to be impactful and relevant for several folks that are probably on the webinar today. First, SilverOak updates. I have great news. We have some new team members. We hired a new tax director who is Jason Warden. So Jason, we want to welcome you to the team. Really look forward to having you as part of the organization. I'm sure you're going to bring a lot of value to the firm and frankly to our clients. So we look forward to getting you introduced to more of our clients and getting you engaged into the process. And then we have an associate paraplanner that will be starting next month. It's a new role that we have in the organization that we just recently filled. From an investment quality scoring system perspective, we've had a couple of things happen here.
We are in the process of replacing one of our international positions due to a management level change of that investment. And then I'm really excited about this, but 3 funds that we've had on our IQs list for many, many years that were closed to our new clients have reopened to our clients. So they'll now be able to be utilized.
And those funds, just to be a little bit more specific, have not reopened to the general public, but more so to institutional investors. So because we're institutional, we have been able to gain access through one means or another in getting our clients, our new clients, into those positions. And then lastly, our website is currently in the process of being updated. I know we said this last quarter or the quarter prior, but we do hope by the end of the year to roll out that as an exciting new feature. And then our year-end reminders, we're not going to go through all these, but one to point out is year-end capital gain distributions. We're seeing numbers, what, similar, Jonathan, to last year?
Similar, and they might be a little bit higher.
Similar to higher. And I know we've seen a couple that are a lot higher. So I want our clients to know we're looking at this very, very proactively, and we will be likely making some decisions over the next 2 to 3 weeks in which positions we may want to transition out of to avoid the distribution, and which ones maybe we just stay with the distribution because selling them would create more taxes than incurred in just keeping the distribution. So something that we're going to be proactively reaching out to our clients about. If you're on today's webinar and you're not working with us, I really encourage you to look at your portfolio, because this is probably going to come to us as a surprise to some clients, or excuse me, not clients, but some investors. Hopefully none of our clients are surprised, because
Right.
we're going to be talking to them.
Yes.
Lastly, we've got some adjustments in annual contributions for next year. These are the new 401k limits, as well as the new HSA and IRA limits. The only thing that I would add to this is that under the 2019 HSA contribution limits, remember, you will continue to have a extra catch-up of $1,000 that you can make into the HSA if you're 55 or older. So that would increase the amount by $1,000 for the HSA, the health savings account. And then Social Security came out with their new updated numbers, which we've shown here. And Medicare actually came out with their new numbers. And by the way, we are in the enrollment period for Medicare. So if you are Medicare eligible, i.e. 65 or older, and you have enrolled, October 15th to December 7th is the open enrollment period. So I really encourage you to look at your current plan. There's a lot of changes happening for 2019. If you have questions, reach out to us. We can talk to you about them. And if we need to, we can get you in contact with an expert in this particular area. So with that, we would encourage you to reach out to your SilverOak advisor with any question that you might have from today's webinar, and also with any topic that you might want us to address in future webinars. Otherwise, again, thank you for your time, and I hope you have a wonderful day. If you aren't working with the SilverOak advisor and you want to reach out to us, my number is listed here. It's 952-896-5701. Thank you.
Thank you.